Let's see if we can go across to our market master of the day, Pankaj Tibrewal. He's joining in now. Pankaj, great to have you on. Always a pleasure to be chatting with you. So, it's interesting. The market's gone through this 10% correction and now it's kind of settled into a consolidation band. So much is going on around us, right? From geopolitics to tariff talk to major interest rate action. We're awaiting the Fed next week. And a change of guard at our own central bank. So given the extent of news, information and noise, what do you expect? More consolidation? But is the downside intact? I mean, have we made our lows, at least for now?
Good morning, Surabhi. If you look at this correction has been a very healthy one. Though we are down about 10 to 11% from the peak, but index actually masked the damage. When we were looking at about 4,600 stock universe, and about 75% of that is down by more than 20% plus. And even we have seen cuts of 30, 40, 50%. And many of those stocks have not still come back. Even markets have recovered a bit. So I think over the next 12 to 18 months, we should look at range-bound markets, maybe 22, 500, 23 on the downside, because earnings would provide some support, and probably 25, 25 and a half on the upside. And within this band, I think stock picking will be rewarded. And what we are seeing is that the breadth of the market is getting narrower and narrower. The style shift has started to happen. Last 3-4 years was all about momentum, beta, value. For the last 6 months, what we are seeing post-election is quality is making a comeback. We are seeing growth getting rewarded again. We are seeing low volatility outperforming. So I think style regime change has also started to happen. Also, Surabhi, don't forget from a macro perspective, first half we have seen a severe slowdown in the economy and led by various factors which have been spoken about, like government expenditure being slow. And don't forget this year, in the first 7 months, government met just 42% of the target. This has been the lowest since 2010. And hence we saw a severe slowdown at the ground level. Going into the second half, our sense and the feedback from the ecosystem is that the things have started to improve, and probably government expenditure from the last quarter should actually pull up the economic parameters, and high frequency indicators have started to suggest that. However, my only worry is that the expectation of the street for FY26 earning growth is still on the higher side at about 15 to 16%. And I think in the next 2 quarters, still the street will readjust its earnings forecast for next year. In our sense, it will be about 10 to 11% earnings growth. And hence market returns will more be a function of earnings growth. Last 4 years, we compounded at 20-21%, and markets clearly reflected that momentum in earnings. If earnings growth is slowing down, probably we should also moderate our return expectation. And hence, we believe that last 3-4 years have been extremely charitable. There was no differentiation between luck and skill. And I think now it will be men versus boys as you move ahead into the next 12 to 18 months.
Well put, Pankaj. Now let's get to the actionable ideas for 2025. This is Reema here. In an earlier conversation, you'd spoken about being positive on insurance. But now increasingly what we've picked up, CNBC-TV18 has learned from sources, is that IRDAI has flagged concerns about this over-dependence of insurance companies on their bank assurance platforms, and the stocks have been under pressure. Pull up an SBI Life and HDFC Life over the last couple of days. Are you still bullish on insurance? If this happens, if the IRDAI takes some measures to, address this concern, will it hurt insurance? Does it change the thesis?
No, Reema, it doesn't change the thesis. The runway for growth from an insurance perspective is very long, both on general as well as life. These disruptions will keep on happening from a regulatory angle, but all these companies are very, very strong, and the growth opportunity is very large. If we get opportunities at lower levels, this is one sector where we should be positive on in the BFSI segment. And also the financialization of savings. We have seen how exchanges, RTAs, depositories have behaved over the last 1.5, 2 years. They have given phenomenal returns. And we believe that in the BFSI space, now there are enough options rather than only depending on banks, whether private or public. You have insurance, you have capital marketplace, you have NBFCs, and whole plethora of other related activities. And hence, I think that the weightage of BFSI in any portfolio compared to 5, 6 years back is not only dependent on banking, but the entire lot. And we continue to remain positive on banking and financials. And within that, insurance, capital marketplace are our preferable place, preferred bets. Also, from a 2025 perspective, couple of sectors which are looking probably interesting and maybe Contra at this point of time. One, I believe, is cement. I think the worst in cement is behind us. The benefits of consolidation has not been seen. And at this level of profitability, Reema, it's suicidal to put incremental capacities because you are earning 5, 6% return on capital. Entrepreneurs are better off parking that money in fixed deposit rather than going for expansion. Hence, our belief is that profitability has to improve to justify new capital expenditure in cement sector. And that's one area over the next 24 months which can show momentum as you move ahead. The second, I think, is metals. It's a complete contra thought, but we believe that the contribution of metal sector to the overall profitability pool in the country is back to 2001-2 levels. And that's an interesting space to be in because two of the largest economies in the world will have a fiscal loose policy. US on one side and incrementally China on the other side. So our belief is that this sector is under-owned and probably incrementally you could see momentum getting developed on commodities and metals as a sector. And the third is specialty chemicals. For the last 2.5 years, we have seen the sector seeing downgrade in earnings cycle led by slowdown destocking. I think we are coming towards an end, probably in the third or the fourth quarter. And our sense, meeting so many companies and the entire ecosystem is that the worst is behind in chemicals. And probably in the next 2 years, the earnings CAGR in this sector is likely to be higher than the earnings CAGR we have seen in the past 2 years. So I think this sector could also find favor among investors as you move ahead once investors start seeing growth in across the companies in the sector. So these three could be the contra bets as we speak. Otherwise, consumption has started to look interesting. It's a K-shaped recovery. It's a mixed picture, but I think valuations have started factoring in a lot of pessimism. And in certain cases, we believe on the consumer discretionary side, there is some interesting bets emerging. Even on the staple side, after the correction, what we have seen, we were looking at our numbers, and on a FY27 basis, many companies have started to look a bit attractive, assuming a normalized consumption scenario over the next 24 months. So this is how we should be positioned moving into 25 in terms of our sectoral preferences at the margin.
Very, very interesting calls, Pankaj. I think I'm going to remember all of them or most of them. Just for the benefit of our viewers repeating, what you're saying is that three contra sectors look very interesting. They have not performed so far, but you will watch out for steel, metals, overall, cement and chemicals. And you're also looking at opportunities maybe in consumption. On consumption, Pankaj, elaborate a little more because it's a very confusing picture. And I want to understand when you're saying that, yes, obviously stocks have cooled off, these, FMCG, large FMCG companies. But then how much are you willing to pay and what is the kind of growth you're penciling in? I mean, there's a debate saying whether for 5-6% kind of volume growth, whether you should be paying top dollar. But you're saying valuations have become comfortable. Just give us some numbers, growth and the PE that you're okay with.
So let's look at consumption into three buckets. And I believe that we will make a mistake if we look consumption as an aggregate part. So there is India 1, which is the top 10% of India, where the aggregate per capita is about $10,000 to $12,000. And globally, if you look at once you cross that $10,000 mark, your expenditure on grocery basic necessities flatten out. And you don't spend more on that, you spend more on experiences, other discretionary. And that 10% is driving the Indian consumption. The next 30%, where the per capita is between $3,500 to $4,000, is the aspirational India. If you provide them with right quality products, right pricing, they are there to lap it up. And many companies, for example, Judio's, Trent, some of the other names have addressed that part in the tier 2, tier 3, tier 4 cities, and they are seeing phenomenal growth. And the rest 60% is between $1,000 to $1,500 per capita. They are struggling because of inflation, because of EMI, because of many other things. And the stress is visible if you look at the data of MFIs or FMCG players, which are catering to the basic needs. Our sense is that if you focus on the top 10 and the next 30% of India, which is India 1 and India 2, and companies which are doing brilliantly out there are those companies which are catering to those two sectors. And our preferences in consumption that don't paint the entire sector with the same brush. Have stock, which could cater to India 1 and India 2. And I think your portfolio should do well. On the other side, when I look after the correction now, a lot of companies probably have come to about, between 35, 40 times earnings in FY26 or FY27. Some of the FMCG names as well. And we are pricing and penciling in the worst of consumption basket right now. However, if you look at the ground level, the rural has started to pick up. The commentary across rural, whether it be two-wheelers, whether it be tractors, have been positive. And many of the FMCG players also have started talking about rural being positive. So I think if you move into FY25, 6 and 27, I think consumption basket as a whole should start showing momentum. We are seeing at the worst pricing. And overall, my sense is that this sector is no longer uniform. You have to pick right companies, right sector, which are catering to the right audience, and hence you will not get disappointed. So our sense is that we are very stock specific in this sector, but this is an interesting opportunity where many consumer names are coming between 35 to 45 times. And when I look at the other sectors, relatively speaking, which are B2B, they are trading at that valuation on a FY26-27 basis. So I think some incremental positions could start to build upon. And don't forget, Surabhi, good prices, good news don't come together. So quality companies during bad times have to be looked into. And some of the value retailing guys are looking good. Some of the consumer discretionary names are looking good. And maybe after the correction, some of the FMCG names will also start to look good. So that will be our approach towards consumption.
Very interesting. So that becomes a bit of a fourth contra call, if I can call it that, because not too many on the street are willing to stick their neck out right now in favor of, bread and butter kind of consumption. Very interesting and golden words there, right? That great earnings and great stock prices rarely come together. So yeah, something to think about. Well, fantastic conversation as always, Pankaj. Thank you so much for joining us today. And in case we don't speak till the end of the year, wish you a very, very happy new year in advance.
Same to you, Surabhi, and same to the entire team of CNBC-18 and all your viewers. Happy New Year.
Thank you. Thank you so much.